Financial reporting standards enhance transparency, consistency, and comparability by defining the principles and disclosure requirements that organizations need to include in their financial statements. The standards also promote accountability by requiring management to disclose information that is relevant and useful to investors and other users of financial statements. The International Financial Reporting Standards 7, or IFRS 7, requires management to disclose the significance of financial instruments and the nature and extent of risks attached to these instruments. Financial instruments include cash and cash equivalents, equity instruments, accounts receivable, accounts payable, borrowings, and financial derivatives. The primary risks relating to financial instruments include credit, foreign exchange, interest rate, commodity, liquidity, and funding risks. The organization is therefore required to disclose both quantitative and qualitative information regarding the nature and extent of these risks. Specifically, IFRS 7 requires disclosure of the different categories of financial instruments. This includes financial assets and liabilities measured at fair value through profit or loss, financial assets and liabilities measured at amortized cost, and financial instruments measured at fair value through other comprehensive income. Other important disclosures include any financial instruments pledged as collateral for liabilities or contingent liabilities and the terms and conditions relating to the pledge, any reclassifications or transfers of financial instruments, and any offsetting financial assets and liabilities. The organization is also required to provide specific disclosures relating to the nature and extent of financial risks such as credit, liquidity, and market risk. This is necessary to enable the users of the financial statements to effectively evaluate an entity's exposure to such risks. Let's now look at an example. Consider the following disclosures made by SICK Limited in its 2020 annual report. The entity identified foreign exchange, interest rate, liquidity, and credit risk as financial risks that it is exposed to. The entity also disclosed the controls or actions management take to manage these risks. As an example, the company manages foreign exchange risk by creating a natural hedge by matching debt with the underlying local currency earnings and investments. SICK also disclosed that its exposure to interest rate risk mainly arises from its long-term borrowings. To protect against this risk, the company utilizes interest rate swaps and options in accordance with its treasury policy. As can be noted from this disclosure, the company also discloses the weighted average interest rate for its Australian and respective foreign currency denominated borrowings. Finally, SICK also discloses both its liquidity and credit risk exposure. As an example, the company has provided a table in its annual report that analyzes its financial liabilities into relevant maturity groupings. Note that this disclosure includes exposures to derivatives such as the interest rate swaps and options. To recap, organizations are required to disclose the significance of their financial instruments to the entity's financial statements. Organizations are also required to disclose the nature and extent of risks relating to financial instruments. These disclosures enable investors and other users of financial statements to assess the entity's degree of exposure to financial risks.